Are you tired of taking trades inside of very messy environments where the market is simply just consolidating or immediately stops you out? Then during this video I'm going to be sharing with you major insights when it comes to knowing when to trade and more importantly knowing when not to trade. Let's dive into today's video. I hope that you will enjoy it. So as mentioned throughout the intro, during this video I will be explaining to you how to know when to trade and more importantly when not to trade. The majority of you are probably coming to the charts and you're looking for a price pattern, and when the price pattern presents itself, you're probably simply taking a trade just because it appears. However, I would like you to understand that based upon the environment that we're currently engaging in, you can already anticipate whether or not that price pattern is going to work. Therefore, I'm going to be sharing with you very specific rules that are going to help you out significantly when it comes to finding the right environment to be looking at the market set. So when it comes to knowing when to trade and more importantly when not to trade, first of all I would like you to understand the following. In front of you, you can see a schematic with the text higher time frame anticipation. Make a game plan and stick to it. Look, if you purely come to the charts and you see a price pattern and you just take a trade because the price pattern is there, you're already losing before you even put on the trade. Surely you might get lucky once or twice, but you will not achieve the consistency which you're looking for by simply doing that. The reason why is because at the end of the day you must be able to first of all look at what is the higher time frame anticipation which you have. Look, I understand that it's so easy to just look for a price pattern, take a trade or follow an indicator and simply take trades because it gives you buys and sell signals. However, understand that in order for you to achieve consistency, you must first be able to follow a routine. Meaning, you must follow a simple routine which allows you to anticipate what's going to happen next. You see this on the higher time frames. You don't see this on the lower time frames. Therefore, when you come to the charts, the first thing which should be on your mind is the following. What is my higher time frame anticipation right now? That right there is where the focus has to be on. Focus on being able to determine what is the game plan for the day. The reason why you're not achieving the consistency which you're looking for is because you're getting screwed up in the middle right here between your point of interest and your draw liquidity. I'm sure that you've had this in the past where you set out a clear game plan, where you set out, okay, I'm looking at the markets from this level only, that's my point of interest, and when we get there, I anticipate that the market is going to draw towards the opposing side. How many times have you impulsively taken a trade in the middle, where you are getting caught up inside of the engineering of liquidity? Look, in the middle is where the majority of people screw up. Therefore, your focus has to be on recognizing where the point of interest is, because when that point of interest is and you're bullish, only from there on you can be looking at the scenario of, okay, let's look for potential buys from the point of interest towards your draw liquidity. If the market is bearish and you're anticipating lower prices, you only show up to the charts when your bearish point of interest has been met. Meaning, you only show up to the charts when the market reaches that old high, for example, when it takes out that buy-side liquidity pool, when it reaches that higher time frame imbalance, for example, or that key level in general. When the market reaches that point of interest, only then can you be looking for the signs that signal to you, hey, we're going to be reversing towards the opposing side of liquidity, which is sell-side liquidity. Therefore, make a game plan and stick to it. Look, I understand that it's so easy to simply just go onto the lower time frames and look at entry patterns and simply take them. But if you do that, you cannot complain about the fact that you're not as consistent as you would like to be. Because an entry pattern doesn't mean anything. An entry pattern by itself absolutely has no meaning behind why the market is moving the way that it's moving. Think about all the times you saw bearish breakers get created and still the market ran up higher. Or all the time you saw bullish or value gaps get created and you saw the market still rip through them. Why oh why is that occurring? Because you're not able to see yet from this bigger perspective. So look at it from the way of, okay, you have a bigger fractal, and inside of that bigger fractal, smaller fractals play out. It's not that the smaller fractals actually determine how the bigger fractals are going to deliver. No. You always move from the higher time frames down to the smaller time frames. And that is why higher time frame anticipation has to be in place. If you cannot define what you are anticipating on the higher time frames and you have no clue what's going on, you don't even have any business looking at the lower time frames. Meaning, if you see nothing on the higher time frames, don't even zoom in. Make a game plan and stick to it. That's the main takeaway which I want you to have from this part of this lecture. Secondly, when it comes to environment selection, there are a few rules which I would like you to start paying attention to. First of all, the day in advance of CPI and NFP is a no trading day. Every single month, this is a given. These are the right days to travel. The morning session in advance of FOMC is a no trading session, meaning whenever we have FOMC throughout the PM session, never look at the morning session. Your focus should be on days with high impact news, meaning on the red folder news days when there's high impact news at 8:30 a.m. or at 10 a.m. or even at 9:45 a.m. Whenever there is high impact news, you have a very clear window of time during which a volatility injection is going to take place. That volatility injection is going to get utilized for what? It's going to get utilized either for manipulation purposes or distribution purposes. These are the types of days where you see the cleanest low resistance liquidity runs taking place. If there is no high impact news, we can still look at the markets. However, our focus has to be on the 9:30 open as our main volatility injection for the day. We will be paying attention to whether or not around this window of time there will be clean signs of clean delivery taking place. Environment selection is so underrated, and the majority of traders are unaware of what we've discussed so far. All that they can look for is lower time frame price patterns, and they think that the price pattern is the reason why price is going to go up and down. But if you are unable to prepare well for the trading session and day, you're already losing. And therefore, learn how to prepare properly. Because look, you're competing against the smartest people in the world. These big entities, they hire people that are so intelligent. These algorithms are so advanced and they're designed to make use of you as a human. If you're simply going to behave like the majority of people do, that simply show to the charts and push buttons for the sake of pushing buttons, what do you expect? Of course you're going to lose. So understand that you must be able to pay attention to environment selection and make sure that you have a fair chance. Next to that, I want you to focus on environment recognition. I want you to focus on markets which have been trending for days or weeks. Meaning, the higher time frame institutional order flow has to be clear. Whether it be bullish, where the markets are expanding higher, or where the markets are expanding lower. If you cannot see this in the market which you are interested in, it's a good idea to maybe take some time off and wait until the higher time frame institutional order flow does become clear. Because think back what we started this video with. If you're unable to anticipate what's going to happen on the higher time frames, then you're already losing. And then you're already setting yourself up for failure. So learn to be able to make an anticipation on the higher time frames. And once you are able to make that anticipation based upon the higher time frames, only then can you consider looking at the lower time frames. Secondly, if you cannot define your point of interest or your draw liquidity, don't zoom into the lower time frames. I do not care how many times I need to repeat that, but if you cannot define your POI and DOL clearly from the hourly chart or from a daily chart, you have absolutely no business in going into the 1 minute chart or maybe even sub 1 minute chart. The reason being is because if you go into the lower time frames too soon, what will happen is that because you don't have a bigger picture in mind, you're going to get trapped into lower time frame chop. And that right there is something I want you to be aware of. Simply paying attention to the higher time frames and making sure that you have your analysis made on the higher time frames and then waiting for your point of interest to be reached is going to make sure that you participate only in runs that are low resistance. Because think about it, right? If you simply take a trade because that price pattern appears off that breaker or whatsoever, what's happening is that you're actually just taking every single breaker that appears. But it's not every single breaker that's going to deliver clean. You must be able to recognize manipulation on the higher time frames into your POI, because as that manipulation is taking place, that is when you can anticipate that distribution will have to follow afterwards always. And thirdly, if there's SMT on both sides of the marketplace, relative to time cycles, the highs and lows, don't zoom into the lower time frames. The reason why this is a very important rule is because when it comes to environment recognition, if there is SMT on both sides of the marketplace, This is setting up a consolidating environment. It's setting up an environment in which high resistance security runs are going to take place. That is not an environment where you can anticipate that the market is going to deliver in a very clean way. Therefore, these are the types of environments where it's best to simply sit it out. With that being said, this video comes to an end. I hope that you found it insightful. I hope that the rules which I outlined to you are clear enough. These are very simplistic rules. However, I promise that if you start adhering to these rules and you start investigating how many times on the high impact news days there are clean opportunities and on how many times on no news days, 9:30 or around 9:30 am, there will be an opportunity, I promise that you will never be thinking to yourself, oh, I should trade now even though I don't know what the higher time frame direction is, or I don't know what the higher time frame analysis is. If you don't know what the higher time frame analysis is, never ever zoom in. And I don't care how many times I need to repeat that during this video, but I want you to write it down for yourself. I want to thank you for watching this video all the way to the end. This was a short one. However, this is a very important lesson which I've shared with you, and I hope that you're able to see the value in these rules as well. I want to wish you good luck in your studies and good luck in the future. I hope forward to seeing you in the gap.